Welcome to the daily update, where I'll go over the action in the market for Friday, February 28th, and we'll see how things look for Monday, March 3rd. Okay, we're still negative in the short and intermediate term, but we did see pretty nice bounce. In fact, on a percentage basis, we were up on Friday as much as we were down on Thursday with the S&P 500. But it looks like there's two key things that are really in play right now from a technical analysis perspective. We bounced off of the 200-day moving average with the NASDAQ, and we started to go up from there. And now we're right back to the underside of the 100 period moving average for the S&P 500. Yeah, there's millions of people that look at these things, and these become critical points, and it all makes sense. That's why I look at other markets outside of the S&P. We sometimes get clues off the mid caps or the NASDAQ 100. Well, on Friday, it was off the NASDAQ composite itself. That's been a pretty influential composite lately. And since last summer, it's been outperforming the NASDAQ 100. So I was keeping an eye on that. We went down, hit the 200-day moving average, and that's when we started to come back up. And then right near the close, we had a real up thrust, but we stopped right at the 100-day moving average. So yeah, I get criticized from time to time for analysis paralysis. Well, this is how you bring everything together. It's not all confined to just one index or one stock. Things come together and you can see them forming the picture, but sometimes you get your clues from other areas. Okay, so let's go back and talk about what happened. Right at the open, we had a higher open and we got up to the daily pivot at 59.05. So now we were dealing again with the 5900 level. And it was like, okay, is this going to provide overhead resistance? We got a little bit above 5900 and then we went up to the daily pivot and then we turned and started to go down. It's like, okay, is this going to be more of a decline? We did not have positive seasonality for Friday. In fact, it was quite negative. And so to expect things to continue to go down, and we were looking negative already, was not necessarily a surprise. This actually took us negative. Then we just kind of chopped around for a little bit, but we set up some kind of a base. And then after lunch, near the end of the day, we saw some late day buying coming in because the 200-day moving average on the NASDAQ held, and we got back above the unchanged level and we got up to the daily pivot and then we closed above R1. There was a real spike at the end. So we got back above 5,900. We're even a point above 5,950 right now. So we were up 1.59%. We were down 1.59% on Thursday. We were above average with volume and we're still negative though in the short intermediate term. We're still positive in the long term. But this short-term oversold condition that we were seeing, this is when I'm more apt to pull the trigger because the bigger picture is positive. We were looking to go down. We hit a pretty significant support level and then came up off of that. And so it's like, okay, it looks like we're going to get a little bit of a bounce from here because the bigger picture is still in play while the smaller picture, which right now is the short and intermediate term, that has been turning negative. So we're looking for things to switch back and look positive. Now, there's still more to this story that's going to unfold here. We're still seeing more of a defensive shift in the market, but we can only go with what we see right now. And things are looking a little more defensive right now, but in Friday's session, at least for the time being, support has held. And interest rates continue to go down or dropping with the 10-year yield. The dollar ended up being up, and that didn't really have much of an impact there. And but then all the geopolitical things going on. There was a real stormy meeting between Trump and Zelenskyy in the White House, and that's of course headlines right now. I'm not sure how much this won't have an impact on the stock market, but the whole Epstein thing, that's so much, at least to this point, is a nothing burger. And you have to wonder is something else in the background part of the plan, or was this just a major goof with things? And then anything can escalate at any time because we live in this period where things are changing so quickly, and you've got these tariffs coming up that may be enacted this upcoming week. Are there going to be negotiations concerning that? So, yeah, there's just a lot of things going on right now. Okay, so this was a broad-based bounce. The market had been pretty negative lately, and we were seeing it turning more defensive. And there's this buy the dip mentality, which, as I say over and over, I do not participate in, but other people do. And this is something that people think, yeah, I'm getting something on sale. It looks like we're going back up. I wait for the evidence to come together to show that things are actually turning one way, either positive or negative. But this was a bounce after we had been seeing some negative action going into the end of February. And there was a pretty heated meeting between Trump and Zelenskyy. And this is, of course, it has to do with Ukraine. And the VIX is back below 20. Now, after Thursday, we had gone above 20. That was another thing I was watching too, is that the VIX started to come down. We got into the 19 range. It's still high, but it's much more negative when we get above 20. 20 and above, that's when we see the negative annualized returns. And then right in going into the close, the 100 period simple moving average is acting as resistance with the 200-day simple moving average acting as support, and but that's not on the S&P. That's on the NASDAQ itself. And then another thing that came out because of the core PCE and the all the economic reports on Friday, and I'll go over this in the weekend video. The GDP now forecast has gone to negative. Now the market could have just freaked out over this, but it's been freaking out about other things leading up to Friday, where yeah, this is just a forecast, and it usually it's off, okay, from what GDP numbers really are. But we haven't seen this before in a long time, where it was revised down to -1.5%, where it had been at a positive 2.3%. That's the growth estimate. And to see that switch over negative. Now, we don't know what the actual GDP is going to come out as, but this is kind of a big deal. It means things are looking weaker. Now, they revised this and it could come back up and be positive. We don't know that yet, but to see this go negative is kind of a big deal. If you watched the video for Friday, we had a long list on the short term. And this is where I say when the bigger picture is positive, watch for a bounce. That's why I was watching lots of different indexes on Friday, lots of different support levels. It ended up being the NASDAQ right at the 200-day moving average, and that's a big deal in and of itself. But this list is now quite a bit shorter. We just have the CCI 14 and 20 and the stochastics that are still extreme negative. We don't have, oops, we don't have anything in the intermediate term. We had a couple of things that were on there after Thursday. They've now fallen off. No change to the overall scenario. The hope was with the core PCE coming out, and I'll go through that here in just a moment, that maybe there would shed some light on, okay, what is the Fed likely to do? The dollar was up, interest rates were down. We're at 4.23%, where we had been at 4.28% with the 10-year yield. And sentiment did tick up. It had been, excuse me, it had been at 18 after Thursday. Now it's at 20, but that's still extreme. And this is when we look at, okay, we've got the NASDAQ hitting its 200-day moving average. We've had a pretty negative time. Our long list of short-term indicators is extreme, but the bigger picture is still positive. Okay, and we're still at that point where we start to consider using this in a contrarian fashion, that maybe things are a little too pessimistic. And but we're still inverted with the 10 to the 3 month. That this is the third day now, third trading day, where we've gone back to the 10-year to 3 month yield curve flipping back. Instead of going back to being normal, it's actually inverted. So we are still negative though with our trend. The ADX is still going up above its moving average. We're still below 20 though. And then with the update, the bias is positive because we had a pretty nice broad-based advance, but we really didn't go anywhere. Just go back to Wednesday. You could take Thursday and Friday out. We're at the same place. but I'm still keeping the momentum at negative for the time being. You might be able to say a little bit mixed. We're not seeing that much of an improvement. What we're seeing are some of the extreme negative conditions. Those are wearing off, but we're not seeing things really switching back positive. But at the same time, some of the things that have been hanging in there more positive, they're still hanging in there and looking positive. And I'll go show you the charts. Now, I don't have charts for these, though. These are not real influential economic reports that came out. With the advanced international trade in goods minus 153.3, that's more negative than the minus 122 billion. And the retail inventories were down 0.1%. Last time they were down 0.5%. Wholesale inventories were up 0.7%. Last time they were down 0.4%. These were the main headline numbers. Personal income. This came in a lot hotter than expected. Up 0.9%. They expected it to be up 0.3%. Last time it was up 0.4%. Personal spending decreased. So you're seeing income going up and spending going down. Is that more defensive on the consumer front? It was down 0.2%. They expected it to be up 0.2%. Last time it was up 0.8%. The PCE prices, that came in as expected, up 0.3%, and the same as what we saw last time. This is the inflation component, the core PCE. It was as expected, up 0.3%, but up from the 0.2% that came out last time. Chicago PMI came in at 45.5. They expected it at 41.2, but it's up from the 39.5 that came out last time. Okay, here we go. Personal income and spending year over year. Looking at the income actually dropping down here on a year over year basis, and we're flat to slightly declining with the spending. Core year over year is declining, but we're still above this 2.5% level. Month over month, we actually saw spending go negative. Haven't seen that now for quite a while. And the Chicago PMI showed a lot of improvement in its latest reading. All right, then earnings well ahead of economic realities. This chart pops up from time to time from Isabel Net, and depending on how you measure it, it's just showing that what they're projecting earnings to be is getting way out of line with what we've seen in the past. And this orange line here, this is the earnings growth trend line. And then the red line is the estimates going up into 2026. And these two lines are actually all of these lines are actually getting kind of far apart from each other. And that might just mean the market's getting a bit ahead of itself on an earnings basis. Then, but left, the US market is concentrated as it ever has been. This is more historical. What were the big stocks going back through history at any given time? And you might want to pause this and just look at this over. IBM's in this list going up in through the 70s and 80s. And then you get into the year 2000s and it's off the list and it's completely different companies now. When I first started in the market back in in the early to mid 90s, these were all of the companies that we were talking about. And at that time, but they're not really in the list now. And so it can change over a period of time. So some of you might find this interesting. And then lots of bears for stocks near new highs. We had the individual investor report come out that I went over in Friday's video. And how do things perform when they're really negative? And they're really negative right now. Well, again, when they're as negative as they came out in the latest report, that's another area that we can look at using as a contrarian indicator. And this is pretty fuzzy, and I apologize for that. The green diamonds here, this just shows when this happened, and then you can see what happened after that. So we have positive returns, 1 month, 3 months, 6 months, and then 12 months out. So the odds are still when individual investors get really pessimistic, things can still look pretty good going forward. And then what's the expenditures on capital that companies are plowing into their companies? And I've been talking about this, and this is a lot in the news. A lot of this has to do with AI. And this just takes Meta, Alphabet, or Google, Microsoft, and Amazon, and this is projecting what are they going to be spending going forward. And that could really help the economy as well. But you've got these companies just putting massive amounts of money into what they want to be developing for the future. And then the household net worth as a percent of disposable income, we're up here. And I have to move this around a little bit, a little bar that you can't see. The AI boom has helped encourage significant wealth. And so this is going up here. And then the price to earnings growth, this is another measure that's used. And even though Europe's been doing pretty good with their market lately, the US is still outperforming on a relative basis when you look forward at projected earnings growth. I didn't really spend any time on Twitter there. But this here's the intraday chart, and for some reason, stock charts they don't have the intraday volume for Friday. It's coming up okay on the daily charts, but their intraday charts, it's all blank here. But we had a higher open. We just about got up above the 5,900 level to the daily pivot. And it looked like, okay, maybe we're going to stall out here. And we started to kind of chop around, go down. And then this looked like, okay, are we going to break a little bit lower? But it was still kind of early in the day. We did go negative, but then we found some support right around the 5850 level. And just it seemed like there really wasn't much going on. Then after lunch on the East Coast, this is when we saw some buying coming in, got back above the unchanged level, broke above the daily pivot, and then a real big spike going into the close above R1. So was this a dead cat bounce in the middle of things being more negative, or is this actually the beginning of something now for things to turn back more positive? That's the question we're trying to answer. And this is just showing how things were a little bit quiet here before the market opened. We're actually drifting down. And then we had the gyration during the day and then the big move up going into the close. And now things are shut down for the weekend. We're still negative, but possibly improving here. When we look at large cap growth to value, the blue is still under the red, even though both went up. And then looking at the S&P growth of value here, where we did see a little bit of an improvement, but overall we've been really declining lately. Then on an end of day basis, you can see everything's green here. On the right-hand side is growth, on the left-hand side is value, in the middle is the corresponding ETF, where growth outperformed with the large caps, mid caps, and the small caps. So seeing a little bit of a change here. Now, in the bigger picture, we're still positive with small cap growth to value, but we've been seeing some real weakness underneath the 200 period moving average with this ratio, and we've just been kind of chopping around lately. A similar thing with mid cap growth to value, except we're below the 50-day moving average, but still above the 200-day moving average with the ratio. But it ticked up a little bit, and just a little bit of a tick here with S&P growth to value. Now this is a little more positive, even though we're underneath the 50-day moving average. The uptrend is still more intact than we're seeing for the mid caps and especially for the small caps. Now, this is another area that could potentially be some support. The growth to value ratio with these two ETFs, we came down to the 250-day moving average, and now we kind of bounced up off of that. There's a little bit of a tick up there. Now, we broke down below this before, going back to the summer and fall in 2024. Now, this level held earlier in 2024, and we had a nice run up after that. Is that going to be what we see going forward here? We're going to have look at this chart, all of our other growth to value charts, and see are they confirming that maybe growth is starting to show some favor again. We look at discretionary to staples, really no change with the overall ratio. And discretionary is just kind of hanging around its 50-day moving average. Where we're seeing a lot of the action right now is in the staples sector. And we're still below the 100-day moving average with large cap growth. We didn't get down to the 200-day moving average. We got kind of close, but we saw some recovery, at least in Friday's session. Now, looking at the trend, we are negative because the red line's above the green line. Also, this is a strengthening trend because the ADX is going up above the moving average. It's not officially a trend until we go above 20. We are starting to cross above 20 in the short term, though. So now a strengthening trending environment that is negative, according to this in the short term. So it's like Friday really didn't have that much of an impact other than the red line coming down slightly. We were above average with volume, and we're still above the midpoint here of the moving average with the ulcer index. Fear is still really high, according to this gauge. And we did drop down underneath 20 with the VIX. So that's seen as somewhat positive that it's under 20, but we're still in the 19s, and that's considered negative and a much higher reading than what we've seen lately. We also saw a bit of a drop off here with the VIX of the VIX, but we're still well above these moving averages. The momentum of the VIX is still up. That hasn't changed yet, and that's more negative. And we're right on the border here. We really dropped down with the skew index, but we're not quite out of this red area yet. This is another variation of the VIX. We ticked down barely here with this fear gauge, and we ticked down just a little bit with the other fear gauge. So we saw a little bit of working off of fear, but nothing to really change things all that much. And we are still seeing the risk on to risk off ratio continue to decline. Okay, we have a big up day on Friday, and this ratio goes down. Now it's only down 0.25%, but it really fell on Thursday, and it continued to fall on Friday. This is still a little bit of a warning sign here. We would expect this to go up when it actually went down. And we're still going up here when we do a ratio between large caps and small caps. And again, it's not that large caps are doing all that great. It's that small caps are really struggling. And we did decline with the daily chart of the equity put call ratio enough to slightly turn down with the 5-day chart and the 10-day chart, showing a little bit of fear coming off. And we came down with the volatility risk premium, but we're still above the band, showing that there's still fear in the market being projected forward. Now, the advanced decline line, this really has held up, and it's not that we saw a lot of weakness in here. It's because they were coming out of the mega caps and going into the rest of the S&P. And so we've been just hanging on, going sideways here, and it did go up, and we bounced up a little bit here with the advanced decline line based on volume. But it's still positive because we're above these advancing moving averages. And we're above zero and going up with the advanced minus decliners over a 10-day period. But this had been looking better even after Thursday's session. And the new highs versus new lows, still seeing more new highs, a little bit of an expansion of the new lows. We're still going up, even though this is a little choppy with the 5-day chart, but we're starting to level off here with the 10-day chart. We had crossed slightly below zero with the advanced decline ratio in the short term. Now we're back above zero. That turned things a little more positive. And we bounced off the moving average here with accumulation distribution. So that's, you can still treat it as negative unless you count this going back up as being positive. It depends on your personal interpretation. Ignore this indicator at the bottom right now. It's clearly not giving us a useful signal. But for right now, we have not dropped below the moving average. But we're still declining when we look at the Chaikin money flow. Now the green, that's a histogram. It's went up a little bit, but the red line is still coming down. We turned up a little bit here with the Chaikin oscillator, but we're still below the moving average. So 2 out of our 3 smart money indicators are still negative, even though they're showing some improvement, where you could say accumulation distribution is positive because it bounced off the moving average. We're still negative here. The vortex, even with Friday's update, the red line's going up. Now the green line turned up a little bit, but overall it has been declining. No real changes here with the cumulative advanced decline line based on price. We've been just chopping sideways, seeing a little bit more of a bounce here based on volume. The NYSE cumulative advanced decline line did show some improvement there. That's broader market. But when you look at the regular NYC advanced decline line, really nothing's been happening all that much. Same thing with this other NYC advanced decline line, but on both of these, we're still above the 50-day moving average. Saw a little bit of a tick up with the NYC common stock based on price, a little bit more of an advance based on volume. And I'm still counting the advanced decline line studies as positive because of where the S&P is. We never did drop below the moving average. Coming back up to the moving average with the NYC common stock, coming up to the moving average with the mid caps, turning up but still below the moving average with the small caps. Now, this is broader based and a little bit longer term. The 5 period moving average of the highs and lows across the broad market were still negative. And we crossed back above 50 with those stocks inside the S&P above their 20 period moving averages. Slight improvement there. We're back above 50 with the 50 period moving average steady, the 100 period moving average steady, and we never did go below 50 with the 200 period moving average steady, but all of these showed some improvement. On a short-term basis, now we're starting to see the March pivot points come into play here. It makes this chart pretty hard to read. You can see there was a real pickup in volume, and it wasn't options expiration either. We saw an improvement with the 20, 50, and 200 period moving averages on the S&P. No longer extreme negative with the Stochk RSI or the Williams percent R. Coming up, but still extreme with the CCI 14 and the CCI 20. And we're no longer extreme negative with the short-term stochastic. We're just barely extreme negative, but turning up in the intermediate short term. We're still declining with the long short-term stochastic. And the force index bounced up here, but it's still negative. We're still vulnerable with the short-term trend. Even with the advance on Friday, we're still below both the blue line and the green line. And so these are continuing to go down. We're still below the simple and exponential moving average based on 20 periods. That's why the short-term trend is negative, or why I classify it as such. We had come down to the -3 channel on our standard deviations chart. That means we're getting a little extreme. We bounce back up and we're just on the border between the -1 and -2 channel. We bounced back above zero with the balance of power after it had crossed negative. We're no longer extreme negative with the CMB composite. The go no go is still negative with the deep purple smoke on the water bars here. Bouncing up off of the lowest low value here, but still below the midpoint, and the midpoint's going down. The TTM squeeze, though, it didn't like what it saw on Friday. It's continuing to decline and is negative. We're still declining with the ease of movement. We're above the moving average here with the standard deviation, as we've been seeing a lot of recent movement in price. And we're still declining and below zero with the Arun indicator. It's more negative than positive. And then the McClellan oscillator, which had, excuse me here, which had dropped below zero. That turns things negative. It crossed back above zero after Friday. So we're going up slightly based on price, but we're still declining based on volume. A mixed picture there. We improved, but we're still below zero with the McClellan oscillator. So we're still going down with the summation index based on price and volume for the NYSE. This is potentially an improvement. We're turning back up with the Swelling trading oscillator, and we crossed above zero based on price. We're improving, but still below zero based on volume. Momentum is still negative, though. The PMO is going down. We're below the moving average based on price and volume, but we saw a little bit of improvement with the PMOs that are rising. The buy signals are pretty much flat, and we're flat with the PMOs above zero. Not an awful lot of change there. We did go from negative to neutral with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR since the dots are on top. Momentum in the short term continues to be negative. Short to somewhat intermediate term with the MACD, it's still going down. So all of our momentum oscillators, though, are still negative in the short, intermediate, and long term. The Copic curve is also showing momentum is negative. Not much of a change here with the Sean trend meter. We did go slightly below 50 after Thursday. Well, after Friday, we're back slightly above 50 with the money flow index. Improved, but still below 50 with the ultimate oscillator. Still above the moving average with on-balance volume. We're no longer extreme negative with the short-term RSI, and we showed some improvement, but we're still below 50 with the intermediate term RSI. The condition of the intermediate term trend, yeah, we bounced back up here, but we're still below the lines, so the lines are continuing to decline. We're still below the simple and exponential moving average based on 50 periods, and this seems to be rather critical now, the 100 period moving averages. We lost that on Thursday, and that was turning things more negative. Well, we did bounce up and we closed right at the 50 period simple, excuse me, the 100 period simple moving average in Friday's session. And until proven otherwise, that's acting as resistance. So looking at all of our moving averages for the S&P, below the 20, below the 50, right back at the 100. And we're still going down below 50 with the bullish percent index. It has not turned positive. We're declining with the NYSE bullish percent index as well as the NASDAQ 100 bullish percent index. So you can see not an awful lot of improvement really happened in Friday's session. We did come back above the cloud though with the Ichimoku cloud here. We're back above this green area. We see the blue line and the red line kind of on top of each other. That's more neutral, but both lines are going down, so that would be more negative. It's really hard to see, but the green line is coming back up a little bit after it had been declining. And then this is longer term where we're having a really difficult time with this trend channel going back to 2009. Every time we come up near that, we can't seem to stay at it. And we end up falling back after that. And we started this in early December, and we've been seeing that continue. We're still negative with the Heikin-Ashi chart with the black candles. We're still negative with the Kegi chart. It's red and pointing down. We're negative with the Renko chart, and we're negative with the three-line break. So nothing really changed there. In fact, it got even a little bit more negative. The little bit of a downward move that we saw, that drew in another O after Friday. So we're still seeing a double bottom breakdown. Sounds like a dance. Okay, so the point and figure chart, there was enough of a movement there to draw in another O. Long term, still above the midpoint here with the 150 and 200 period moving averages, but they've been just chopping along. This one's actually been declining overall, where we've been going more sideways to slightly declining with the 200 period moving average. Still negative in the short term with all the indexes that we follow. Still negative in the intermediate term with the mid caps and small caps. Bonds are positive in the short and intermediate term. Commodities have now switched to negative in the short term. All the sectors ended up bouncing, with the financials leading the pack higher, which we like. We want the financial sector to do well if we're more positive on things. Discretionary's been getting hit hard. Is this a dead cat bounce here? It ended up performing pretty well. And see, communication was also up. And then tech. All of these were up over 1%. But some of these areas have been beaten down pretty hard lately. So we started off a little more negative here, but the dollar was going up. So we saw a bearish MACD crossover for the euro against the dollar. And then the dollar had a positive bullish MACD crossover. And then the NASDAQ, and this, I was really watching this close, where we were going down to 18.5, 18.4. And then that was around where we were at with the 200 period moving average. The healthcare sector had a BPI cross below 50. That's a defensive sector that's now turned more negative. Then the NASDAQ started to climb. It got up to 18.6, 18.7, 18.8. Materials had a BPI cross back above 30. And then, as I said earlier, the S&P was able to get back above 5,900. We're in the mid 5,900s now. And then near the end of the day, oil crossed below 70. And here's the Dow where we're coming back up here, but still hitting this pivot point that is still good for February. We're going to be switching over to the March pivot points come Monday's session. The diamonds have gone from negative to neutral with the Elder's Impulse system. Here's the big one. We came right down to the 200-day moving average with the NASDAQ. And again, I want to stress why, even though I focus everything that I do on the S&P 500, this is why I look at other indexes. Because it's like, what's going on? What's happening? Well, if you were watching the NASDAQ chart, you knew what was going on at that point, and we were able to bounce up off of that. Now, is this going to continue to go up? We don't know. But in Friday's session, this held as support. Well, we're not even close to the 200-day moving average. Well, we're kind of close, but we did bounce up here with the NASDAQ 100. But I was watching both of these charts. I saw the NASDAQ one hitting first, and that's when we started to go back up. And we're still negative, though, with the Qs, looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still negative. We're still well below the 200-day moving average with the small caps, as measured by the S&P 600. We're still below with the Russell 2000 small cap index as well. So just not much of a change overall here. But we did switch over to neutral after being negative with the small caps. And we're still below the 200-day moving average with the mid caps. And we gone from negative to neutral with the Elder's Impulse system for the mid caps. Financial sector, though, up over 2%. Okay, this is good. This is healthy for the market to have the financial sector doing well. The Wilshire bounced back up. It's still below its 50-day moving average, as well as the total U.S. stock ETF. So a bit of a bounce, but no real change. The FANG index also bounced up, but still below its 50-day moving average. And then Apple was up almost 2% here, coming back up to its 50-day moving average. Google below its 200-day moving average, but it still climbed a percent. Microsoft up over a percent, but seeing a death cross here and has been seeing some weakness lately. Amazon below its 50-day moving average, it was up 1.7%. Meta bouncing up off of its 50-day moving average. Nvidia coming back up to its 200-day moving average. And Tesla also bouncing up off of its 200-day moving average. Netflix bouncing up a little bit more off of its 50-day moving average. And we're seeing a bit of a pickup here when we compare on a short-term basis US to world stocks, or longer term, we're seeing that correlation drop off. We're under 70 now with oil, as I pointed out with the alerts a moment ago. We did really see a solid day for the dollar, but we're still below the 50-day moving average here. But at longer term, it's still in an uptrend. We're declining and dealing with the 200-day moving average with the 10-year yield. And we went up with the 10-year based on price. We're inverted with the 10 to the 3 month. So this is what we're going to be watching now. We'll also be and I look at it every day. I just don't show it here. I'll also be watching the 10 to the 2 year, and that's what most people follow. I also follow the 10 to the 3 month yield curve. And no real improvement with our growth to value ratios. Still going down with the Qs to S&P, discretionary to S&P, large cap growth to large cap value, going down with the large caps, mid caps, and small caps. So a little bit of a tick up, but nothing that substantial. And we're still going up here with the Staples to S&P ratio. This really going up. That means the market's getting more defensive. So what's our outlook for Monday? We are still negative in the short and intermediate term. We are now trending. I'm probably going to drop this now because it looks like that trend is going to last for a bit. And we bounced on Friday. Right now, that's all we can treat it as. It didn't really change the overall technical picture. Now we're going to get a big report on Monday, the ISM manufacturing. And then construction spending can have an impact too. And then all the crazy stuff, the geopolitical things, what's going on politically in the US, what's happening between the US and Ukraine right now with the meetings that are going on there and all that stuff. And then just all the craziness that's been happening. And then here's the economic calendar for the upcoming week. We're not going to have any reports on Tuesday, but then we're going to get the ISM non-manufacturing or services. That's going to come out on Wednesday. Initial jobless claims and continuing claims, that's been kind of a big deal lately. And we're also going to get productivity and unit labor costs. And then we're getting the big employment report on Friday. Here's another look at the calendar for the economic reports. Seasonally is pretty positive because we're coming into a new month now. We're positive with the Dow and S&P, neutral to positive with the NASDAQ. Now, I changed some of these around here for March. This has been what's on this slide for quite a while because we're still working off of January being up 2.7%, and that tends to do well for the whole year. And then looking at the statistics, we're up 65% of the time for March, down 35% of the time going back to the last 75 years. And then I'll deal with the options information when we get closer to that time. And here I rearranged this around a little bit. The first half of March is the second best performing part of the year when we look at the median 2 week return going back to 1950. So we got that working for us. And even when we get into the second half of March, it's still not great, but it performs better than the second half of February. And then looking at March, going from 1964 to 2023, we're up with an average return of 1%, 65% of the time. So, accumulation distribution, these are still negative, but improving. But they haven't switched back over to positive yet, unless you choose to think that the accumulation distribution bouncing up off of the moving average is positive. We're still showing some improvement here, but we're negative with the S&P and NYSE McClellan oscillators and summation indexes because we're still declining with the S&P based on volume. Parabolic SAR is negative. The bullish percent indexes are negative. The momentum is negative. EASA movement, ultimate oscillator, those are still negative. The vortex is negative, and the momentum for the NASDAQ 100 is negative. Positive signs. Yeah, I'm keeping this on the positive side because longer term growth of value is still in uptrends for the S&P, but they have shown some weakness and discretionary to staples still longer term positive, but there has been some weakness there. The advanced decline lines, especially around the S&P, are still looking good. The Swindle trading oscillators turning back up. The money flow is positive, and the financial sector had a really solid day on Friday. So our conclusion, we're negative in the short and intermediate term, but we're still long-term positive. And we're negative in the short term, but we did bounce. And that's what we saw here in the intermediate term with the 100 period simple moving average acting as resistance. And we continue to be positive in the long term. Thank you. Have a great weekend, and I will talk to you in the next video.